Good afternoon, Market Rebels, and happy Monday, and welcome to our first trading tune-up of October. We started this back in May. I can't believe it's October already, but nice little rally, almost at one point up about 3% during the day on SPY. I think we were about plus 2.6 or so going into the close, but certainly looks like it's a better sign than what we were seeing last week. But what I thought would be a helpful topic today is one that Stu and I talked about in one of our breakout sessions for those of you who joined us in Dallas at RebelCon. And it's called the inside versus the outside view. And it's one of my favorite topics it's in decision theory. This comes up a lot. Statistics, they usually call it the inside versus the outside view. I think it's critically important at all times, but especially in markets like this, when you have so many question marks out there, whether it's inflation or recessions and things like that. And I hear so many traders that say, oh, well, now that we know what's going to happen, let's all go short or let's all go long or something like that. And this is where you have to really take a step back and say, let's consider the inside versus the outside view. So what exactly is that? Well, when it comes to financial decisions, it's easy to let your emotions bias your views. As I mentioned in the presentations in there, one of the mottos that a lot of traders live by is that it's always darkest just before it goes pitch black. But what they do is they tend to forget about mean reversion. Whenever we swing the pendulum one side really hard, there's a tendency for it to swing back to the other. This is called mean reversion. Things tend to gravitate towards the averages. They don't go to the extremes and then keep getting more extreme. But yet, when your emotions get involved, it's very easy to think that's what's going to happen. So this is where, again, you have to take a step back and look at the inside versus the outside. So what is that? Well, the inside view is a subjective, short-term bias view. It's really what your emotions are telling you is going to happen or what you would like to have happen. Okay, so that's what we call the inside view. The outside view is an objective, long-term, scientific view. That's really saying, I'm not going to let my emotions, or at least try not to let my emotions influence this decision. I'm going to act like a jury. Just show me the evidence, and let's see what a hypothetical jury would come up with as a conclusion based on all of the evidence. So when you are making market decisions, consider the outside view. That doesn't mean you have to get super detailed, although theoretically you should, to go find this long-term scientific view, but at least consider it. Say what has happened in the long run, in the past. So let's start with the inside view. This is one of my favorite examples when I used to teach a finance course on this very topic right here. And in 2008, Big Brown was the overwhelming favorite to win the Triple Crown. Now, Big Brown was a super contender at the time. He was sponsored by UPS, which is where he got his name from. He won the Kentucky Derby, and then he won the Preakness. Now, the Kentucky, he won by 4 3/4 lengths, which is a lot for a horse race. For the Preakness, won by 5 1/4. You're going, man, how could this thing not win the Triple Crown? So we got the upcoming Belmont Stakes, and Casino Drive was the biggest contender, and it dropped from the race. So now you're thinking, what could be better? This is a shoe-in. Let's go bet the farm because we know that he's going to win. Do you kind of get that sensation that this is just a layup? You can feel your emotions going, oh, this is going to be an easy one. That's an inside view. It's your emotions talking. It's kind of what you want to happen. So how would you rate your chances of winning based on this information? Again, you'd probably think it's virtually 100%. And a lot of people did. But before we go lay our bets, let's take a different view. Let's look at the outside view. Now, remember, this is the long-term scientific view. Think of yourself as a jury saying, just show me all of the evidence. Only 11 horses earned the Triple Crown in the previous century. That's going to be important. None in the past 30 years. Of 29 horses with the possibility to win the Triple Crown, only 11 succeeded. That's probably the big telltale right there. So you'd probably have to say, an outside view would say that 11 out of 29, or about a 38% chance to win. That would be an outside view. Doesn't matter how strong your emotions are. The outside view says, yeah, but a lot of people, or a lot of horses have had that chance and couldn't do it. There's something very difficult about completing the third. This is the history of it. But we could also break it down some more. Prior to 1950, just 8 of 9 had succeeded, so about 88%. But after 1950, only 3 of 20. That's pretty interesting. So you might even say 3 out of 20 would be a 15% chance to win. That would also be a respectable guess. Now, the odds makers, I believe, were giving it around 40, maybe 42% chance to win, but it wasn't close to 100, which is what the average person was thinking. And again, that's because they're basing it on emotions, what they want to have happen. So how do you think Big Brown did? Are you going to take the inside view or the outside view? It's always hard to not lean towards that inside view and go, my gosh, he's shattering every single record out there. His biggest competitor dropped from the race. So what happened? Dead last. Never been done in horse racing history where a contender finished dead last. They did a full physical of the horse, not a thing wrong with it, at least that they could find. So you're going, how is that possible? This is the outside view. It happens. It's just called a long-term expected value. It's looking at all of the data, not on what you want to happen. So this is, again, super important for market outlook. So think about, by today's standards, long-term market returns are about 8 to 10%, depending on the time that you're measuring. Okay, 8 to 10%. But from 2019 to 2021, the market returned 29%, 16, and 27% respectively. And what were people thinking? Oh, well, it's obviously going to continue higher. We're on a tear. This time is different. Just like we heard all of the other times when we thought it was different. Heard that same story at the crash of 2000. You have to say this is not normal. Your inside view is saying, oh, let's go long and just not bother hedging anything because it's obviously going to continue higher. The outside view says that is not going to happen. It's not your best guess. Now, sure, you can trade the market, you can hedge your opinion, but you shouldn't sit there and say, oh, we know that it's going higher just because look at this track record. That's the inside view. Okay, so should you expect it to continue? Not in the least. That doesn't mean that it can't, but it shouldn't be your expectation. Now, what about this one? During COVID, SPY fell about 36% in a month. Think about that. We all went through it. It's a remarkable landslide. Should you expect it to continue coming unhinged? Probably not. You should probably expect that the pendulum swung, to the downside, and that it's going to revert at some point. At a minimum, to think that you should be in the middle of this selling is just wrong. The better view is at some point we have to do some type of buying, and that's where our strategies need to lead us. So remember that you should not try to manage risks in downturns. Risk management is done before things get risky. If you try to manage during downturns, you're asking to buy insurance once the house is on fire. Can you buy insurance when the house is on fire? Sure. You're just going to pay for exactly the damages plus a small premium to the insurance company. It will be an absolute loss to you. Same thing in the financial markets. Can you go buy puts in the middle of it? Absolutely you can. I can almost guarantee you they will end up being losing deals. That's why you have to have this stuff in place before things get bad. And again, that's why we tell traders to trade the markets, but hedge your opinions. And this is why it's so important to understand your strategies. So one of the best ways you can do to kind of keep yourself in check is to remember the outside view. Ask yourself, what is most likely to happen? We've got over 200 years of stock market history. How many times have we had, unbelievable recessions that just where the whole world came undone? Of course it can happen, but how many times has it happened? How many times have we had just runaway inflation? Has it happened? Maybe not runaway, certainly not hyperinflations, thank goodness. But, in the 80s, we got up to 18, 20% in the risk-free markets. Certainly by US standards, pretty high. But that was a small episode, again, in a 200-year history. So we have to always keep that in check. So the main thing, just remember to make your good better, your better best. And it's all about understanding markets and understanding strategies. And I just thought this might be a helpful thing to help keep those emotions in check. So for anyone who'd like to learn more about options, strategies, hedging, rolling, morphing, all the things that we love to teach here at Market Rebellion, we are offering a free one-on-one coaching assessment. Pick a topic, anything you'd like to talk about, with one of our world-class coaches. So the phone number is 888-809-8058. Love to sit down and have a chat with you, and you'd be surprised at what they can teach you in a 30-minute span. Absolutely no cost. It's pretty hard to say no to a risk-free deal, right? So please give them a call. And again, I hope that helps. We'll look forward to seeing you on Thursday. And then I've got a special little puzzle for you on Friday. So we'll talk about that on Thursday, and we'll see you then. Thank you.